Assalamualaikum and hello everyone. So for today, my group will be presenting on AEON's financial performance. Moving to our teammates, I myself, Nordin Balkis Inchira, alongside with my team members, Iza Madiha and Siti Haja, will be presenting thoroughly on AEON's financial performance. So now, let's get down to the company background. AEON was established in Malaysia on the 50th September in 1984. AEON is a household name that runs a widespread network of departmental stores, supermarkets, and pharmacies. Not only that, AEON also embraced the digital age with My AEON To Go e-commerce platform, which offers various services efficiently. Next, AEON business model. AEON aims to be the go-to spot for all customers' needs by providing a comprehensive range of products and services that caters to the ever-evolving demands in the merging online and offline shopping experiences. The efficiency in managing the supply chain and strategic locations are the key successness of AEON, which making them stays ahead in the competitive retail market. As for the core values, AEON have this one guiding light philosophy which is called as customer first. AEON believes that they can exceed their own customers' expectations by truly understanding what their customer needs. Other than that, AEON have these three principles which is called integrity, innovation, and excellence, which drive them to continuously improve and enhance the shopping experiences of their own customers. Last but not least, AEON's market position. So, AEON's network draws in countless visitors due to the unique product mixes. As the largest mall operator in Malaysia, AEON focuses on expanding their offerings and improving their customer experiences, which solidified their market position, which ensures the continued growth and successness of AEON.
Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Haja and I will explain about usage of each category of ratio. Firstly is liquidity ratio. Like the current ratio and quick ratio are like a financial health checkup for a company. They help us to see if the company can easily cover its short-term debts with its short-term asset, just like making sure you have enough cash to pay your monthly bill. Secondly is debt management ratio. Debt management ratio such as the debt to equity ratio and interest coverage ratio help us understand how much the company relies on borrowed money. It's like checking if you are drowning in debt. This ratio shows how well the company can manage and repay its long-term debt. Thirdly is asset management ratio. Asset management ratio like inventory turnover and receivables turnover tell us how efficiently a company is using its asset. They help us see if the company is making the most out of what it has. High turnover rates usually mean the company is doing a good job at managing its resources and keeping operations running smoothly. Next is profitability ratio. Profitability ratio like net profit margin, return on asset, and return on equity shows us how good a company is making money. They help us to see if the company is efficiently turning sales into profit. Lastly is market value ratio. Market value ratio such as the price to earnings ratio and market to book ratio are used to get a sense of how the company stock is performing. They help investors figure out if a stock is a good deal or if it's overvalued. Think of it like checking the price tag on an item to see if it's worth this much. Next, I will explain about the importance of ratio in business. Firstly, financial health. This ratio indicates the company's ability to pay off its short-term liabilities with short-term assets, ensuring smooth operation without liquidity crisis. Secondly is risk management. Ratio also play a significant role in the risk management. Debt ratios, such as debt to equity ratio, are used to assess the level of financial leverage and potential risks associated with high debt levels. Next is operational efficiency. Efficiency ratios such as inventory turnover and receivables turnover are highlighted as tools to measure how well a company utilizes its assets. These ratios help in identifying areas where the business can improve its operational process and resource management. Next is performance measurement. Financial ratios are crucial for evaluating a company's performance. They offer a quantitative basis to compare different aspects of the business such as profitability, efficiency, and liquidity. Lastly, investment decision. Ratios like return on equity and return on asset provide insights into how effectively a company is using its shareholders' equity and assets to generate profit, making them crucial for assessing the viability of investment. That's all from me. Thank you.
Now, I will present an analysis of AEON's financial performance for the fiscal years 2032 and 2033. This analysis will provide a clear overview of our key financial ratios. Let's begin with AEON's liquidity ratios, which measure our ability to meet short-term financial obligations. The current ratio improved slightly from 0.50 times in 2032 to 0.51 times in 2033, indicating minor gains in asset management or reduced liabilities. However, it remains well below the industry benchmark of 1.0, signaling liquidity constraints that may limit AEON's ability to meet unexpected obligations, raising concerns for creditors. AEON's current assets are insufficient to cover its current liabilities. The quick ratio declined from 0.70 times in 2032 to 0.40 times in 2033, indicating weaker liquidity and a heavier reliance on inventory. This reflects insufficient liquid assets to cover immediate liabilities, signaling a reduced ability to meet short-term obligations. AEON's liquidity remains a critical concern. Addressing this issue is essential to ensure smooth operational functioning and financial resilience. Moving to debt ratios, which reflect our long-term financial health, the debt ratio decreased from 66.70% in 2032 to 64.41% in 2033, showing a slight reduction in financial leverage. AEON has reduced its reliance on debt to finance assets, but with over 60% of assets still financed through debt, the company remains highly leveraged, facing elevated financial risk and interest burdens during low profit periods. The times interest earn ratio remains stable at 2.84 times from 2032 to 2033, indicating AEON's consistent ability to cover its interest obligation, earning RM2.84 in operating income for every RM1 of interest expense. The ratio reflects AEON's stable capacity to meet its interest payments. Next, let's discuss efficiency ratios, which evaluate operational performance. Inventory turnover improved from 6.84 times in 2032 to 7.30 times in 2023, reflecting more efficient inventory management. This increase demonstrates AEON's ability to sell and restock inventory more effectively, which is critical in retail. The average collection period increased from 6.80 days in 2032 to 7.87 days in 2033, indicating slower receivables collection. This lengthening ties up cash, potentially impacting liquidity and increasing credit risk. While the increase is slight, it may signal weaker credit control, cash flow constraints, or lenient credit terms. Strengthening credit policies or collection strategies could help address this issue. Total asset turnover improved from 0.76 times in 2032 to 0.79 times in 2033, indicating better asset utilization. AEON generated RM0.79 in revenue for every RM1 of asset, up from RM0.76, reflecting improved operational efficiency and a disciplined approach to maximizing returns from its asset base. AEON is improving operational efficiency, but slower receivables collection is tying up cash and needs to be addressed. Finally, let's review profitability ratios, which measure our ability to generate returns. The operating profit margin declined from 7.88% in 2032 to 7.35% in 2033, indicating higher operating costs relative to revenue. AEON earned 7.35 cents in operating profit per 1 ringgit of revenue, down from 7.88 cents. This decline suggests rising expenses, potentially due to inflation, supply chain issues, or pricing pressures, and highlights the need for improved cost control to protect profitability. The net profit margin increased slightly from 2.69% in 2032 to 2.78% in 2033, reflecting improved cost efficiency or better control over non-operating expenses. AEON earned 2.78 cents in net profit per 1 ringgit of revenue, up from 2.69 cents, signaling a modest enhancement in overall profitability. Return on assets increased from 2.05% in 2032 to 2.20% in 2033, indicating improved efficiency in generating profits from total assets. AEON earned 2.20 cents in profit per 1 ringgit of assets, up from 2.05 cents, reflecting more effective asset utilization and enhanced operational profitability. Return on equity decreased slightly from 6.36% in 2032 to 6.35% in 2033, reflecting stable but modest profitability from shareholders' equity. Shareholders earn approximately 6.35 cents per 1 ringgit of equity, indicating consistent returns. While stability is positive, the low ROE suggests limited profitability on equity invested, highlighting the need for AEON to enhance profitability to deliver high returns to shareholders. Now, I will present AEON's financial performance for 2033, focusing on key financial ratios compared to the industry averages. AEON's current ratio of 0.51 times is much lower than the industry average of 1.58 times, indicating liquidity challenges and insufficient assets to cover short-term liabilities. This suggests AEON may rely on short-term financing or quick asset turnover, increasing financial risk, particularly during sales decline or economic downturns. AEON's quick ratio of 0.14 times, significantly lower than the industry standard of 1.0 times, indicating a lack of liquid assets to cover immediate liabilities. This suggests the company heavily relies on inventory turnover to meet obligation, exposing it to liquidity risk from potential disruption in inventory flow or sales decline. AEON's inventory turnover ratio of 7.13 times slightly exceeds the industry average of 7.1 times, indicating strong operational efficiency and effective inventory management. This performance suggests AEON maintains optimal inventory levels, minimizes holding costs, and has a robust supply chain that aligns well with customer demand. AEON's lower debt ratio is another area of better financial performance compared to the industry. AEON's lower debt ratio is a positive indicator of financial stability, showing that we rely less on borrowed funds compared to the industry. This reduces financial risk and interest obligation, positioning us well for periods of economic uncertainty. AEON's net profit margin of 2.78% is significantly lower than the industry average of 6.60%, indicating weak profitability. For every 1 ringgit of revenue, AEON retains only 2.78 cents in profit, less than half the industry average. This suggests issues with cost efficiency, pricing strategy, or operating inefficiency. The low margin blocks AEON's ability to generate sustainable profits, affecting reinvestment and shareholders' returns. AEON's return on equity of 6.35% outperforms the industry average of 5.25%, indicating effective use of shareholder equity to generate returns. For every 100 ringgit of equity, AEON generates RM 6.35 in profit, reflecting efficient utilization of shareholder funds and providing a positive signal to current and potential investors.
So now let's go to AEON's strength. First, efficient inventory management. So AEON's inventory turnover ratio of 7.13 times indicates that the company is effectively managing their inventories by ensuring that their products are quickly sold and they don't have to manage the overstocking or understocking problems. Second, moderate debt ratio. So AEON's debt ratio of 64.41% demonstrate that AEON have better control over their financial leverages, which means that they are relying less on debt. It also means that AEON reduces the financial problems or risks and vulnerability in interest rate fluctuations. Lastly, a superior return on equity, which is known as ROE. With the ROE of 6.25%, AEON is delivering better returns to their investors compared to the other companies, because AEON is effectively using their shareholders' equities in generating the profits for AEON. So through these better returns, AEON could gain the shareholders' confidence and attract more possible investors to invest their money more on AEON company. So now let's move on to AEON's weaknesses. So first, weak liquidity positions. AEON's current ratio of 0.51 times and quick ratio of 0.14 times is highlighting that the company may have critical shortfall in liquidity. So AEON may face difficulties in meeting their short-term obligations during the unexpected downturns or economic crises, and it may undermine their creditor confidence. So next, second, low profit margins. So AEON's net profit margin is 2.78%, showing that AEON may face challenges with cost control or pricing strategies due to the high operating expenses, intense competition, or inefficient processes that AEON may have. So for the third weaknesses is extended average collection period. So AEON's average collection periods has increased to 7.87 days in 2023, which indicates that there are inefficiencies in managing the receivables accounts, which results in delaying cash inflows. So AEON is having an issue with extended collection period, could negatively impact the overall working capital. So last but not least, declining operating profit margin, which is the fourth weaknesses for AEON. AEON's operating profit margin has decreased to 7.25% in 2023, which signaling that AEON is having a decline in operational efficiencies. So the drop for this profit margin could be caused by rising costs of raw materials, reduced productivity, and increased competition by other competitors, which indicates that AEON is capturing less profit from their own core operations, and it is affecting the overall profitability of AEON throughout the year. Last but not least, suggestions for improvements. So first, enhancing the liquidity management. AEON should renegotiate their payment terms with their suppliers and explore more structured refinancing options. So by optimizing the working capital, the inventory levels will be reduced to match the sale forecast accurately. So this also will be helping the company to minimize their capital tied up in stock without negatively impacting the customer satisfaction. So second, improve profit margins. So AEON should reassess their pricing strategies by regularly reviewing the cost structures and identifying if there are any inefficiencies in helping them to sustain their profit margins through streamlining operations, because from the streamlining operations, AEON can cut overhead expenses and improve their bottom line more. Okay, so for the third suggestion of improvement is strengthening the receivable collections. So AEON should implement stricter credit policies and offer early payment incentives. Automating invoicing and payment reminders could also help to accelerate the collections of receivable accounts and ensures that the customer are timely following up with the payment. Last but not least, the fourth is invest in operational efficiency. So AEON should focus on optimizing their supply chains and leverage the technologies while providing the training programs for their own employees to enhancing the workforce productivity, which can lead to higher sales and improve the customer loyalty on AEON. In conclusion, AEON's future is depending on its own ability to address these weaknesses with its own strength. By improving the liquidity management, enhancing the profitability, and monitoring the streamlining operations, AEON can position itself well in the financial position and competitiveness. By using a targeted strategies in overcoming the current challenges, AEON is well positioned to enhance their shareholders' value and keep AEON sustainable growth secured in the dynamic retail sector. I believe that is the end of our presentations on AEON's financial performance. Thank you for lending your ears.